So three important economic indicators showed a substantial decline this week. They are as follows. One, the US dollar index declined. I'm going to share a story with you. It's the lowest since 2022. What else declined? Personal spending, consumer spending is down. And the third thing that has declined is personal income. So income is down, falling. People's spending is down, and the US dollar index is down. I'm going to share three articles with you that I think are interrelated. So hopefully you'll stay tuned for the whole show. And let's jump into this. I think it's important for all of us because the last article I'll share with you ties together this concept we've been hearing now a lot of de-dollarization and how this will result in rates staying higher here in the United States for longer. What does that mean? It means things are going to cost more. Everything from your mortgage to your food to your insurance. So it applies to all of us, no matter what economic or income strata you're in. This is out of the coin world. US dollar index drops 0.31% as personal spending falls. US dollar index, the DXY, has recently experienced a notable decline, falling below the 97 mark for the second time in recent months. This downturn was primarily driven by a significant decrease in US personal spending in May, which was the largest decline since the beginning of the year. So this economic indicator dragged down the value of the US dollar, resulting in an intraday decline of 0.31% for the Dixie. That was yesterday on Friday. The index reached a new low from February of 2022. So I guess it's about a 2.5-year low. It's a over 3-year low, standing at 97.48, marking a substantial year-to-date decline. Dollar's recent sell-off has paused temporarily following its decline during Thursday trading. I saw, it's down, okay? And it was down yesterday. This leaves the DXY trading in the low 97s. The dollar decline, the index decline has been attributed to various factors, including the strengthening of other U.S. currencies. Hang on to the end. I'll share with you this whole idea of the China de-dollarization and what the impact's going to be for everybody, such as the euro and Japanese yen, as well as the British pound, trading above 1.37 for the first time since January. Says the recent U.S. dollar index decline is counterintuitive, and of course ties back into tariffs they're saying are inflationary, okay? But we have other factors in play, all right, that are contributing to this dollar decline. Remember, if you guys followed this stuff, it was just seems like a couple of months ago, the dollar, the U.S. index was over about 103, as I recall. So let me share with you the second story from yesterday. Again, CNN, Americans reined in their spending last month. Again, this is having an impact on the dollar. And don't forget, the lower the dollar index falls, the less purchasing power you have. So what are you going to do about it now? What can you do to maybe counteract the effects of the declining dollar? Well, one thing you can do is start acquiring real things. Acquire things that you need now, okay? I'll touch on that at the end of the video, give you some thoughts I have. Out of CNN, the U.S. economic engine sputtered in May. Consumer spending declined for the first time since January, according to new data released Friday. It also showed inflation heated up on an annual basis, okay? Dollar down, spending down, income down, inflation up. Bad recipe. The Commerce Department report showed that consumer spending fell 0.1% last month after rising 0.2% in April. When taking inflation into account, spending declined by 0.3% for the month. A nearly 50% drop-off in motor vehicle sales was a significant driver of the May spending retreat as consumers It's said, they say, rushed to dealerships in March and April, somehow trying to front run the tariffs. Leave your thoughts and comments below. Do you think that's what happened? However, Friday's report also showed that consumers pulled back on spending at restaurants and hotels. It's not just that they're not buying cars right now. Consumer spending powers more than 2/3 of the U.S. economic activity, and economists have expressed concern that the steep tariffs on most imported goods will erode America's resiliency. How many of you are tired of hearing that the tariffs are to blame for all of the ails right now that the consumers are feeling? I'm sick and tired of hearing it. You're not seeing this play out, okay? Again, love to get your thoughts and comments. Everyone's got a different perspective on this, but how often now do we see the CNNs tying back in inflations to everything and all the problems, right? But here, look, apart from autos, households are also shelling out less for services, notably restaurant meals, with volumes flat in May after a little rise in April. How is that related to tariffs? Personal consumption expenditures price index was 2.3% for the 12 months ended in May versus 2.2% in April. On a monthly basis, prices rose 0.1%. Economists, here we go, we're expecting the PCE price index to rise 0.1% from April, resulting in the annual rate ticking up to 2.3%. They expected spending to pick up slightly to 0.3%. Of course, the economists, in this case, as we often hear, were wrong. Excluding the volatile food and energy categories, the core PCE price index rose 0.2% from April and ticked up to 2.7% on an annual basis. So let's talk about the income, because this is a big deal. Personal income fell, right, more than expected for the month. That sank 0.4%. And it says the May decline, they're saying, was largely a reflection of Social Security payments returning to more typical levels. Okay. In March and April, former public workers received large retroactive payments, it says, made under the Social Security Fairness Act for reduced benefits under prior legislation. Despite the recent month's volatility in those income numbers, it says the trend is one where income growth remains quite subdued. Typical economist way of saying it's not good, right? Real disposable income, what's left after taxes, is currently trending at a pace of 1.7% per year, 1.7 year over year. That will bring down consumer spending from the 3% annual pace that we were accustomed to through most of 2024, closer to 1.5% over the coming months, and perhaps even below 1% in the back half of 2025. Think about that. It's 1/2. Real disposable income, according to this statistic, is almost 1/2 of what it was in 2024. That's almost hard to believe. Let me reread it to make sure I'm interpreting the correct way. Leave me your thoughts. Real disposable income, what's left after taxes, is currently trending at a pace of 1.7% year over year. Okay, and it was 3% through most of 2024. All right, so we have prices going up, we have inflation going up, we have real income going down, and therefore we obviously have spending now hitting a wall. Spending is declining. So it says you're much more subject to a stalling, according to this economist. You're exposed to price shocks, oil prices shocks, tariff shocks, interest rate shocks, stock market shocks, and therefore you're more at risk of experiencing a more significant slowdown, or possibly, it says, according to CNN, a recession, right? And it says, and by large, consumers are ill-equipped to weather any kind of economic storm, according to Elizabeth Renter, senior economist at NerdWallet. So we talk about how the consumers, despite what we hear from Jerome Powell, that the job market is strong and everything is fine, we know that most consumers don't even have, $400 or $500 in an account to cover an emergency, right? So here we go. People are not ready for this, all right? They're not equipped to deal with and they're already struggling. They're holding down 2, 3, 4, multiple part-time jobs just to try to make ends meet. And now we have incomes going down and we have prices going up. So let me share with you the last story, which goes back to this idea of de-dollarization and how this, according to this article out of Yahoo Finance, Bazinga, it says Americans are not prepared, according to this Harvard economist, about China's de-dollarization, and it's entitled "Interest Rates Are Going to Be Higher for a Very, Very Long Time." And if this turns out to be accurate, interest rates do stay higher. We know that the Fed's pushing back, is not lowering rates, is not indicated they have any intention anytime soon of lowering rates. Okay, so if you think about, put all these things in the mix, if it turns out to be that rates stay higher for longer, what does that mean? Like I said at the beginning of the video, higher mortgage rates makes houses more unaffordable, higher food costs, higher costs for insurance and everyday items, okay? At a time when, as I just shared with you, personal income is down. So here we go. The global role of the US dollar is shifting, and the consequences for interest rates and the American economy could be long-lasting, according to this guy. That's the warning from Kenneth Rogoff, a professor of economics at Harvard University and former chief economist of the International Monetary Fund, okay, the IMF. Take all this stuff with a grain of salt, but it's worth listening to. In a recent interview with CNBC, Rogoff said the U.S. is entering a new era of fiscal and monetary pressure driven in part by a long-building move away from the dollar in global markets, particularly in Asia, okay? And we've been hearing this about de-dollarization and the weakening dollar, a lot more recently in the news. It's going to put, according to this guy, put pressure on the U.S. budget, interest rates, and Americans are not prepared for any of that, according to Rogoff. The movement, often referred to as de-dollarization, is not new, but Rogoff believes it's accelerating and could lead to a world where the dollar no longer dominates global trade and financial flows the way it has for decades. According to Rogoff, the shift, coupled with U.S. fiscal strain, okay, and that means the sheer amount of the debt that the United States has in trillions and trillions of dollars and growing every second, minute, day. It says it's likely to keep real interest rates elevated for longer than most Americans or investors are expecting. Obviously, the stock market is waiting with bated breath for Powell to reverse course and reduce the interest rates. This guy says, I think real interest rates are going to be higher for a very, very long time. The era of low interest rates is over, this guy says. New economic reality. The dollar's global standing has long helped the U.S. finance its deficit and maintain low borrowing costs. Also means lower costs of interest on its debt, right? When foreign central banks hold dollars or buy U.S. Treasury bonds, it supports demand and keeps interest rates in check. But according to this guy, Rogoff, he argues the trend is starting to reverse, especially as countries like China reduce their treasury holdings and shift away from pegging their currencies to the dollar. And you also, like I shared with you a few minutes ago, are seeing certain currencies strengthen. This is due in part to rising geopolitical tensions and concerns over U.S. sanctions. He says it doesn't mean the dollar is going to be replaced anytime soon or overnight, but it does mean its role could be significantly diminished over the next decade. And then the impact of, he says, what's at stake for Americans? If Rogoff is right, a prolonged period of higher interest rates could impact nearly every corner of the U.S. economy. That includes, here we go, mortgages, credit card rates, business borrowing, and long-term investment returns. It's also likely to put renewed strain on the federal budget. As rates rise, so does the cost of servicing the national debt, which has already surpassed, it says, 120% of GDP. So let me give you just a parting thought, and something that I've talked about on this show for a year and a half now, over that, which is being prepared in the event of an emergency. Part of that, and we talk about the cost of accumulating these things. I talk about food storage, long-term water storage, your security, things that you need or will need in the event of an emergency, whether it's several days, several weeks, several months. We just don't know, right? It's one of those things where you get this stuff, you set it for the most part, and you then forget it. You go on about your life, okay? And one of those things I talk about oftentimes on the show is the long-term food preps. I've done a couple of long videos on it. I'll link a video I did last year on what I do for my long-term food storage, how I stack calories, if you will, and what I do, how I diversify it. And that my go-to for the emergency food is Augustin Farms. Again, I'll leave my affiliate link below in the video, because if these people are correct, and we are going to have prolonged, say higher for longer rates, you're going to see, not only the cost of things not just stay stable, but continue to go up. All right, especially important items that we talk about, including food. Okay, now I'm not telling you the prices are gonna go up. I don't know. None of us have a crystal ball. But looking at all this stuff, and we want to, if you're part of this channel, I think you're of a similar mind that preparedness is just common sense, right? You can't prepare a minute after the emergency or the event takes place. So give it some thought. If you guys are not set up with your long-term food storage, again, Augustin is a product I've been accumulating and buying and using for years, and I do like their product. So give it some consideration. You have lots of other options, obviously, but this all plays into the common theme we're seeing, which is inflation is not coming down. The whole idea of transitory, which was a bunch of BS from the start. We have the dollar weakening, which means you're losing purchasing power on those dollar bills that you have sitting in your wallet each and every day. So buy real things, right? Gold, silver, cryptocurrencies, land, things that have value. But your preps, okay, your security, okay, your food, your water, those things are tangible. They have value, not only monetary value, but they have value to your family if and when you should need it. So I'm going long today. I get it. It's a weekend, but I thought I would share those interrelated, what I think are interrelated stories with you. Hope you got something out of the content. If you don't mind leaving me a like on the video, and also please subscribe to the channel if you're not subscribed. And also do me a favor, even if you think you're subscribed, to check to make sure you haven't been unsubscribed. I know that has been taking place recently with with content creators. So thanks again, everybody, and I will talk to you soon. Bye.